Here's something most people don't know. There's a country across the Pacific Ocean that holds more of your dollars than you do. More than your bank account, more than your retirement fund, more than most Americans combined. Japan owns $1.2 trillion worth of U.S. government debt. And on February 8th, 2026, they're making a decision. Not about your money directly, but about theirs. Whether to keep printing, whether to keep buying, whether to keep holding. And that decision, made in Tokyo, in a language you probably don't speak, by people you've never heard of, will move through the global financial system faster than you can refresh your portfolio. It'll touch U.S. Treasury rates. It'll touch mortgage rates. It'll touch the stock market. It'll touch your dollars. So let me explain what's actually happening, because this isn't about Japan. This is about how connected the money system really is. To understand February 8th, you need to understand Japan's problem. And it's not the problem most countries have. Most countries fight inflation. Japan has been fighting deflation for 30 years. Deflation sounds harmless. Prices go down, your money buys more over time. Great, right? Wrong. Deflation kills economies slowly. Here's why. When people expect prices to fall, they stop spending. Why buy a car today when it'll be cheaper in 6 months? Why invest in a business when revenue will shrink next year? So spending drops, companies cut back, jobs disappear. The economy contracts. And Japan got stuck in this loop for decades. So their government did what central banks do when economies freeze. They printed money. They dropped interest rates. And when I say dropped, I don't mean to 2%. I don't mean to zero. I mean below zero. Negative interest. Think about that. Normally, I borrow $1,000 from you. I pay you back $1,100. Under negative rates, I borrow $1,000 and pay you back $900. You lend money and lose money. Sounds insane, but it happened. Because the Bank of Japan, their central bank, didn't care about profit. They cared about keeping the system alive. And for years, it worked. Sort of. Japan avoided total collapse, but they never fully escaped deflation either. Until recently. Now Japan has a different problem. Inflation. All that money printing, all those negative rates, all those years of stimulus. It finally caught up. Prices are rising. And that changes the entire equation. Because when you're fighting deflation, you can justify extreme policies. Print money, suppress rates, do whatever it takes. But when you have inflation, you're supposed to do the opposite. Raise rates, slow down printing, tighten the system. And that's the decision coming on February 8th. Japan's government wants to keep printing. They want more stimulus, more support for the economy. But they need approval to do it the way they want. If they get approval, stimulus continues. If they don't, it slows down. Either way, this decision will shift Japan's interest rate path. And that shift doesn't stay in Japan. It moves through 3 channels, 3 ways it hits the U.S. economy directly. Let me break them down. First channel, the yen carry trade. For years, Japan had the cheapest borrowing costs in the world. You could borrow yen at close to 0%. So here's what Wall Street did. They borrowed yen in Tokyo. Then they converted that yen into dollars. Then they bought U.S. stocks, U.S. real estate, U.S. bonds, crypto, anything with a higher return. If you're borrowing at 0% and earning 6% in the U.S., that spread is pure profit. This isn't a small trade. This has been one of the largest sources of liquidity flowing into U.S. assets for years. Billions of dollars borrowed cheaply in Japan, invested aggressively in America. Now, here's the problem. If Japan raises rates, borrowing yen gets more expensive. The trade shrinks. That means less money flowing into US assets, less demand for dollars. And when demand drops, prices adjust. That's channel 1. Second channel, Japan's housing market. In Japan, 79% of mortgages are variable rate. Compare that to the US, where it's under 10%. Most Americans lock in fixed rates. Most Japanese don't. So when rates rise in Japan, homeowners feel it immediately. Their monthly payments go up. And Japan just hit the highest interest rates they've seen in 30 years. So millions of homeowners are now paying more than they expected, more than they budgeted for. And if incomes don't rise to match, stress builds. Missed payments, defaults, foreclosures. We've seen this movie before. 2008 in the United States. When housing stress spreads, it doesn't stay contained. It moves into the financial system. Banks tighten lending, credit dries up, spending slows. And Japan is a major economy. When a major economy contracts, the ripple effects are global. That's channel 2. Third channel, US Treasury demand. This is the big one. Japan owns $1.2 trillion in US government debt. They're the largest foreign holder. And there's a reason for that. For years, Japanese investors had a simple choice: lend to their own government at negative rates, or lend to the US government at positive rates. Even 2 or 3% looks attractive when your alternative is losing money. So Japanese capital flooded into US Treasuries. That kept US borrowing costs low. Because when demand for Treasuries is high, the US doesn't need to offer high interest rates to attract buyers. But now, if Japan raises rates and starts paying positive returns at home, Japanese investors have a reason to stay local. They don't need to chase US Treasuries anymore. And when demand for US debt drops, the US has to compete harder. That means offering higher yields, higher interest rates. And those rates don't just affect bond traders. They're the baseline for the entire economy. Mortgage rates follow Treasury yields. Car loans follow Treasury yields. Credit cards, business loans, everything follows the baseline. So if Japan pulls back and Treasury yields rise, borrowing gets more expensive across the board in the US. That's channel 3. Now, zoom out. Japan isn't just dealing with rates and stimulus. They're dealing with debt. Massive debt. Japan's debt to GDP ratio is around 240%. The US is at 120%. You hear people talk about America's $38 trillion national debt like it's a crisis. Japan's problem is twice as large relative to their economy. And now they're considering printing even more money. So you've got a country that fought deflation for 30 years, used extreme policies to survive, now has inflation, has the highest debt load of any developed nation, and is approaching a major policy decision on February 8th. And the reason it matters to you, even if you've never thought about Japan, is threefold. 1. Japan holds more US dollars and treasuries than any other foreign country. 2. Investors have been borrowing yen cheaply and pouring that money into US assets for years. And 3. Japan is a major economy in a connected global system. So when one major player shifts, everyone feels it. But here's the other side. This isn't just risk, it's opportunity. Because Japan is changing how it runs its economy. For decades, Japanese companies operated with a stakeholder-first mentality. Employees matter, customers matter, shareholders matter. Balance across all of them. Compare that to the US, where it's shareholder first. CEOs have legal duties to maximize shareholder value. Stock price is the scoreboard. Japan is shifting towards that model. More focus on returns, more buybacks, more dividends, more efficiency. When a major economy changes its incentive structure like that, behavior changes at the company level. Capital gets allocated differently. Profitability becomes the priority. And for investors, that creates opportunity. You don't need to pick individual Japanese stocks. There are ETFs that give you broad exposure to the Japanese market. But as always, investing has risk. You're not guaranteed to make money. You will lose money at some point. That's part of the game. So do your own research. Never blindly trust anyone online. My goal isn't to tell you what to do. My goal is to help you understand what's happening so you can decide for yourself. Here's the reality. February 8th is a decision point, and decision points move markets. You don't need to predict every detail to understand the impact. Japan's path on money printing and rates will ripple through global liquidity, and global liquidity hits the U.S. stock market fast. We've already seen it happen multiple times over the last 18 months. Japanese policy shifts, U.S. markets react. So, if you're an investor, pay attention. Not because you need to panic, but because understanding the system gives you an edge.
The people who win in this economy are the ones who own assets. Real estate, stocks, businesses, gold, crypto. Diversification across assets and cycles is how you protect yourself. Markets go up, markets go down. Different assets move at different speeds at different times. So instead of trying to perfectly time the market, own the market. You don't need to predict tomorrow. You need exposure, discipline, and a strategy that survives different environments. That's how you build long-term wealth. Not by guessing, by participating. If this helped you see how the global money system actually connects, consider subscribing. I break down how money works, not how we wish it worked.